Financing Disaster Resilient Infrastructure. For this, I request Mr. Shaohua, Director General Department of Project Financing, New Development Bank as Chair, and Dr. Ed Jorge Ijjasz-Vasquez, Senior Director, World Bank as Co-Chair. Following speakers of the session are also requested to join on the dais. Ms. Samantha Cook, Senior Financial Sector Specialist, World Bank. Dr. Charlotte Benson, Principal Disaster Risk Management Specialist, ADB. Professor Patnaik, National Institute of Public Finance and Policy, India. Ms. Anna French, Deputy Head, DFID, India. Mr. Dhananjay, Yellurkar, Head Risk, IDFC, India. For further deliberations, I hand over the session to the chair. Sir.
Thank you. Good afternoon, everybody. And thank you for your patience. I've been noticing that we spend a lot of time on this, and time management has been an issue. So we will try to do a better session. I don't know if I'm going to be successful on this, but we will do better on this time management, because right after this, we're back to lunch. So with this, now this session that we talk about the financing, the disaster resilient infrastructure. The technical session that we have with the panelists today here are basically from the financial institutions, like from the World Bank, from ADB, from DFID, and also from the investment companies, and also from academia. So one point that I would like to put it forward here is that we have the panelists today, and I would like to encourage our panelists to focus on a results-oriented and action-oriented presentation. In addition to the sharing of information, of experiences and lessons learned in the past operations, I would like to encourage our specialists to also look forward and to give tangible, action-oriented, results-oriented proposal and suggestions. Now today that we have our panelists, I will just introduce very briefly Ms. Samantha Cook from the World Bank, and Ms. Charlotte Benson from the Asian Development Bank, Professor Patnaik from the National Institute of Public Finance and Policy, India, and also Ms. Anna French from the DFID and the UK Center for Global Disaster Protection, and also Mr. Dhananjay Yellurkar, the head of risk, IDFC Infrastructure Finance Limited. The discussion, we will focus on a couple of main issues in relation to the financing of the disaster resilient infrastructures. We will be focusing on what are the considerations that drive financing of infrastructure projects. How are disaster risk considerations incorporated in analyzing the feasibility and cost effectiveness of projects? And what are the challenges in adequately incorporating risk considerations in the financing of infrastructure projects? What are some of the innovative approaches to address these challenges? And what is the potential role of insurance in incentivizing risk reduction, encouraging risk reduction? Do insurance markets have the depth and liquidity to play this role? as I noticed that we also have representative from Munich Re and also Swiss Re. I don't know where you're sitting. Could you please recognize yourself? Thank you for your joining us and participation. And we do hope that you can later on also shed some lights and sharing your experiences in the context of disaster resilient infrastructures. And how can risk management in operations and maintenance of infrastructure be sustainably and sufficiently financed? And then what roles can MDBs, our colleagues from World Bank, ADB, and private sectors, investors play? And how can their expertise and best practices be leveraged? One point I would like to add before we start with the presentations is that we do need, learning from the previous sessions, that we do need to have some focuses on the quality at entry or the resilience at entry for the new projects and operations. Now with this, we will start with the presentation of the panelists, and then after that my co-chair will then summarize the points of takeaway and also to lead discussions and also for the close of the session. So now let's welcome Ms. Samantha Cook from the World Bank.
Thank you, Chair, and thank you, distinguished participants. You'll be pleased to see I brought my phone with me on purpose to make sure that I do actually stick to time during this session. Now, while we're here to talk about finance and specifically financing infrastructure, I thought it would be remiss of me not to steal a little bit from my colleague Charlie with the ADB report on infrastructure finance. We heard a lot yesterday banding about 26 trillion, 1.7 trillion per year, or 1.5 trillion per year. I put this slide up on purpose to highlight India within it, but not to highlight the exact amount of finance required. The numbers that I'm focusing on are the gaps. Because once you know what your gaps are, then you can start trying to think about how you finance those gaps. First question with financing the gaps, where are your gaps coming from? Now this one, a little bit off topic, but again, just an example as to how, when you know where your loss is coming from, how you can try and address it with various different financial products. Now, at the moment within India, there's a large agricultural insurance program. At the World Bank, we've been scaling this up. It started with a very small number, 32 million farmers insured. Now we're going to grow this to 120 million. And the way in which we're going to do that is very relevant to this session because we're bringing in the private sector. Previously, it was done through the public sector insurer, but now we're incorporating the private sector in order to generate that competition. And by generating the competition, that's where you start to make things more affordable for the end user. Now, the other component that this will focus on is to do with the financial literacy of the end consumer. While incorporating these technical risk transfer instruments, it's very important that the person whose dollar is going towards it, that they know what it's for, when they can claim from it, and more importantly, when they can't claim from it. Now, at the World Bank, I work on the Disaster Risk Finance and Insurance Program, a very small team. And we look at the disaster risk financing framework. So what we try and do is we try and address two challenges. One, we want to obtain funds fast. And second, we want to spend them effectively. How you go about doing this, I mean, accessing finance is only one piece of the puzzle. In order to be able to spend funds effectively, that's where knowing your financing gap and where it's coming from, that's where it's going to be able to help you. Because once you know that, you can start thinking about, okay, what's the best mechanism for transferring? Is it going to be, we need finance for reconstruction? Do we need it for the emergency relief? What exactly do we need it for? This becomes particularly important when you start looking at your different tools. So for example, if you want to look at relief, what you can see from the graph on the top left is that you don't need a lot of money for your initial relief, but you do need it very, very quickly. In terms of reconstruction, you need a lot more money, but you have more time to get there. You can think about it a little bit longer. You don't need it on day 0. Now, we try and base our thinking on this bottom right picture. I think this is now about our 3rd generation of this chart. But basically, you want different financial tools to address different layers of risk. So at the bottom, these will be your less complicated financial tools, and these are for your more frequent but less severe disasters. So this could be something like a very localized flood, and you might want to finance that through having some form of trust fund. For your more severe events that are less frequent, that's when you start thinking about your market-based instruments and your risk transfer, so some form of insurance, for example. And the reason we structure it this way, and we need to be clear about this, is there is a cost for each of these financial tools. Whether it's just the opportunity cost of holding funds in a trust fund that could otherwise be invested in a project, or whether it's the premium that you're going to be paying for your market-based instruments. So again, this is the last slide which sets the scene for how we do the disaster risk finance within the bank. So we have it within the center of the flower, and then you can see that basically we try and pull in aspects from all over. So we're a very small team within the bank, but we reach quite far because working in isolation isn't going to get us anywhere. We need the expertise from our disaster risk management colleagues. We need the expertise from our engineers that work in our infrastructure, urban development, our water sectors, that sort of thing. Social protection is there as well. We do a lot of work with them. One of the recent areas that we've been focusing on, and this goes back to, again, what I was saying at the beginning, where are your losses coming from? With the Asia-Pacific Economic Cooperation, we've been working a lot under the chairship of Vietnam. Disaster risk finance and insurance was placed as a priority. So what we did was we did a few key pieces of research to identify how things could be better managed within the governments themselves. And so one of these reports was actually done by the bank with our team and with the OECD as well. And with the contingent liabilities, what we're really looking to do is to identify where exactly you're being hit on your budget. So you can do this either by going through and looking at historic expenditures, or you can do it via some form of probabilistic modeling, which is a bit more abstract and a little bit more forward-looking. But again, this gives you a sense. Once you know what that number is, once you've been able to identify how your budget is impacted by a disaster, you can start looking at those different financial tools as to how you can help reduce that, how you can manage your contingent liabilities. It may just be through incentivizing, for example, the purchase of household insurance by basically creating incentives, i.e. some form of premium subsidy, encouraging households to go that step to purchase home insurance. That can help alleviate some of the pressure that's on the national budget because there is the expectation that the government is the insurer of last resort. This one, again, this was done with APEC. Risk management of public assets. Again, the reason I put this up, public assets, yes, but we heard during yesterday's conversation, I think it was Indonesia, 66% of damage and loss came from infrastructure. And I think for Fiji, Samoa, it was 55% or the other way around. In fact, but it's to give you an idea, normally within these scenarios, once you've got your contingent liability, this is your what next. How are you going to do it? The particular bit with this one that I wanted to highlight was what came out of this report, and I'm not going to read through every point on all of my slides, is that the fund execution mechanisms linked to contingency planning, and that phrase is very key in our finance world at the moment, contingency planning, basically Japan and Mexico, which I'll talk about shortly, they were viewed as best practice examples, ultimately. And so we'll talk about how they do it, but contingency planning in particular, the donor community via Ensure Resilience, or even if it's the government, they want a sense as to what their money will be spent on. And having a contingency plan in place not only helps give them that sense of comfort that their money is not going to be misused, misappropriated, but it also helps speed up the initial relief. So Japan, with their infrastructure investments, they strengthen their building codes, they encourage regular maintenance, but what I thought was particularly interesting, and what you'll see from the picture on the right, is the fact that they have pre-disaster agreements with the private companies, which mean that ultimately they can start responding straight away, secure in the mind that any money that they spend, they will ultimately be reimbursed. And that's something which is quite unique and certainly a best practice within the sector. This one is from Mexico. Mexico, they have a very complicated fund. Again, it's used, if you look at the picture on the left, there's a lot of information that's going on there. Ultimately, what you want to look at are two core components. One is for prevention. You can access finance for, say, retrofitting a school, but you're going to have to put money into that investment proposal as well. So Funding will only provide finance if you're prepared to finance that project as well. So it's to make sure that it's really a worthwhile investment. Always having some skin in the game is quite important when trying to get finance. Now, with the reconstruction side of things, what they also did, and this is where incentives really come through, if there's a disaster and you have insurance, you're fine. If, for example, you don't have insurance, the first time the disaster happens, 100% of your costs will be covered. If this happens a second time and you still don't have insurance, that number goes to 50%. Only half of your costs will be covered. If it happens a third time, you're not getting anything. And that's how they've structured it, and it works very well. On the right, in order to be able to finance such a... It is a complicated structure, but it's a very good structure, and it works well in Mexico. Whether it would work well everywhere else has yet to be seen because it involves a lot of manpower. There's a department of about 20 people that work on this. But what you can see is they have a series of different financial instruments that I was talking about earlier in order to be able to finance different aspects. In Colombia, what they did was they instigated a public-private partnership. And so what they've done is they've made sure that they purchase insurance for 38 billion of next-generation road infrastructure. Don't ask me what next-generation road infrastructure is or why it has 4G there, but seemingly the fourth generation must be very impressive. It's certainly very costly. And what they did was they developed some standard terms and conditions from international best practice and applied those. They also, akin to Mexico, they've also introduced basically a highly negative threat that if you're not adhering to these best practices and you're not purchasing insurance, you will lose your job. And that's actually stated in the Act. They've enacted it, so it's quite a severe penalty if you're not doing what you're supposed to. So this is my concluding slide. There were 5 key points that I really wanted to get across. The first is about understanding your risk. Again, we've spoken a lot about that during the forum, but really being able to know how much your risk is and what it's coming from, that's going to enable you to develop your disaster risk financing strategy. You're going to look at multiple instruments because no singular instrument will be able to finance everything. Public-private partnerships, they're worth considering. They're worth considering because not all of the solutions that public-private partnerships offer can be offered by the private sector. They can offer products which otherwise would not be commercially viable. And that's a distinct advantage that they have. And contingency plans. Again, just giving people that sense of comfort that, yes, they know where the money is going to go, what it's going to be spent on, and being able to give that signaling to the end recipients, that in itself is invaluable. So it's worth keeping that one in mind. Thank you.
Thank you very much, Ms. Cook. Now we will turn it to Ms. Benson from the Asian Development Bank.
Thank you. I'd like to begin by thanking the organisers for inviting ADB to participate in this session. I'm delighted to be here. I want to begin my presentation not thankfully with yet another slide on ADB's infrastructure investment needs, but instead just to give you an overview of ADB's approach to disaster risk management. This figure is taken from our operational plan for integrated disaster risk management covering the period 2014 to 2020, and it's read from the bottom upwards. It begins with three key principles and implied requirements for disaster risk management. The first focusing on integrating disaster risk reduction, obviously, into all relevant development actions, and secondly, on addressing the crossover between disaster risk management and climate change adaptation. The third one is of particular relevance to the discussions over today and yesterday, focusing specifically on the principle that levels of expenditure on disaster risk reduction and residual risk management need to reflect long-term risk profiles, and in turn implying the need to develop disaster risk financing capabilities. I'm using disaster risk financing capabilities in this context to talk about both financing for risk reduction and financing for the residual risk. The operational plan then outlines a series of cross-cutting actions leading to strengthened disaster resilience in ADB's 45 developing member countries. There's considerable interest in financing for resilience at the moment, including from the G7. But if you've been following that discussion, a lot of it focuses around essentially increasing coverage of disaster insurance. Now, insurance alone fails to largely tackle the underlying causes of disaster risk. And so if that approach is pursued primarily in isolation, then it provides only a band-aid solution. Moreover, with accumulating disaster risk, both as a consequence of climate change and of continuing development, new investments with insufficient regard to disaster risk, it becomes an increasingly unsustainable band-aid solution, something in fact recognised by the insurance industry itself at COP23 a couple of months ago in Bonn. So it's imperative, therefore, that enhancing finance for disaster-resilient infrastructure, we begin by securing resources for disaster risk reduction first, so that when disasters happen, the resulting losses are that much lower. We immediately hit a problem, though, when governments allocate their very limited budgetary resources, they typically favour investments that are going to provide near immediate streams of positive income. In contrast, for many disaster risk reduction investments, for instance for seismic retrofitting, the benefits of that investment may not flow for a number of years, and when they do flow, they are in the form of averted losses rather than positive income. There's a second series of issues that were discussed yesterday around insufficient understanding of the nature and scale of disaster risk, of opportunities to strengthen resilience, and of related costs and benefits. Again, these inhibit investments in risk reduction. So in addressing these issues, what we're ultimately aiming to do is to reach a situation where disaster resilience is recognised as a core objective of budget planning, but we're some way off that yet. And so what ADB believes might help is to actually establish dedicated resources specifically for disaster risk reduction. So under the recent replenishment of ADB's concessional financing covering the period 2017 to 2020, ADB's donors agreed to set aside some of the concessional assistance specifically and solely for use for disaster risk reduction, both to support standalone disaster risk reduction projects and embedded actions in other development projects. All 17 of ADB's concessional assistance countries are eligible for this money. The motivation behind it is, as I've just basically explained, around enhancing awareness of disaster risk, tackling root causes, catalysing further investment by demonstrating both the opportunities and the benefits of risk reduction. The resources unusually include grants for non-grant countries. I think that's the first time ADB's ever done that. And it also includes some co-financing requirements for less debt-distressed countries to help stimulate public investment in disaster risk reduction. ADB has made available some concessional lending resources to help meet those co-financing requirements should the government so wish to take up those resources, and has added a little bit further in additional concessional lending resources again. And what's been very interesting is to see that many countries are actually taking up that full amount of concessional lending, meaning that with this incentive of some grant financing, they're now indicating that they are actually also willing to borrow for disaster risk reduction, which is a bit of a turn of events. ADB is, of course, also seeking to integrate disaster risk management into its operations more generally, starting with our country partnership strategies. For those of you who are not familiar with those, these are basically ADB's primary document of engagement in each country, and they're renewed in line with a country's national development plan. So in this context, we now recommend that country disaster risk assessments are undertaken for medium and high risk developing member countries to inform the development and focus of the country partnership strategies. As it happens, we're already seeing much, much greater attention being paid to disaster risk in these strategies. Of the current batch of strategies in place, 88% of them acknowledge disaster risk as a challenge, 81% of them identify a specific role for ADB in disaster risk management, and 42% of them identify disaster risk as part of a key priority in the country partnership strategy. At the project level, all projects are screened for climate change and disaster risk using a preliminary environmental screening process, which is basically a checklist, followed by screening and then further assessment as necessary. I wanted to also touch briefly on work ADB is doing to enhance financial preparedness for the residual risk, recognizing that it's not cost efficient, of course, to eliminate disaster risk entirely. There becomes a point where that additional dollar spent on risk reduction is not worth it. Instead, one needs to accept the remaining risk and plan for it, including financially. So in this work, we're basically seeking to ensure timely, adequate, assured flows of post-disaster funding to ensure in turn that the indirect consequences of disasters are limited by more speedy recovery. In the process, we're therefore enabling building back better. If the financing isn't available, of course, corners are lost and those building back better opportunities forgone. We're looking to the text has gone weird then. We're looking to apply a risk-layered structure, which Samantha's already alluded to smooth recovery and reconstruction expenditure over time, to embed incentives for risk reduction in this work around financial preparedness for response, for instance, through risk-based premiums, and of course to stimulate the development of commercial risk transfer markets, which are in an extremely nascent state in many of our developing member countries. So again, this is the layered approach that Samantha's just covered as well, basically seeking to apply the most cost-efficient disaster risk financing tool for each layer of loss, working through risk retention tools that keep the risk on government books, then over to risk transfer and for extreme events, international assistance. So our work in this regard on financial preparedness is divided into two areas. Firstly, around strengthening the enabling environment for enhanced financial preparedness, and secondly, on actual products. Under this first area, we are, for instance, undertaking a series of analyses, country analyses, to explore the enabling environment with a particular focus on risk transfer. This analysis is very important. There are often a number of obstacles to growth, particularly in disaster insurance, that need to be addressed before you can really look at an expansion in coverage. I won't go through these in detail here, but happy to discuss them offline if anybody wants to explore them further. Our work in this area also includes assessments of disaster risk, national disaster risk modelling exercises, support to governments in developing comprehensive disaster risk financing strategies, technical knowledge support, leveraging funding. We've got a new fund in place that was approved just last year, which is supporting innovation around disaster risk financing, and then more general support for strengthening insurance supervision as well. In terms of products, we've got in place contingent disaster loans or grants for now 4 countries in the Pacific, and we're looking to turn that into a regional contingent financing product. We have a 5th country coming on board this year. We're piloting weather index crop insurance in Cambodia, Bangladesh. We're designing currently an insurance pool for city governments in the Philippines, and we're exploring opportunities around microfinance linked products. And of course, we have our more traditional post-disaster funding mechanisms as well, which kick in after a disaster, with some additional concessional financing available for eligible countries to respond to disasters. I wanted to end my presentation by just talking very, very briefly about a new fund in Pakistan, the National Disaster Risk Management Fund, a multi-donor fund which ADB provided $200 million in support for to help establish. Several bilateral donors have also contributed funding to this fund, with additional donors interested. It's aligned with a $3 billion investment need that the government has identified to strengthen the country's disaster resilience. And I want to mention it really because, again, I think it reflects the beginning of perhaps a shift in focus. Here is a government that's actually willing to borrow substantial resources. In addition to the 200 million already borrowed from ADB, there's an additional 300 million planned to be approved in 2019, 370 million again in 2020, huge amounts of money that the government wants to borrow, recognising the enormous toll that disasters have recently had in their country. The loans are on-granted to the fund. The fund in turn is making out grants to both government and non-government entities, providing up to 70% of funding needs. So there is still a matching requirement, again, to leverage further investment in disaster reduction in the country. So I end on hopefully a positive note that countries are beginning to recognise that there is considerable benefit in investing in disaster risk reduction ahead of time. Thank you.
Thank you very much, Ms. Benson. And now let's invite Professor Patnaik for her presentation.
Good afternoon, everybody, and thank you, Mr. Chairman, for inviting me here. My name is Ila Patnaik. I belong to the National Institute of Public Finance and Policy in New Delhi. We are an institute that works, we are a think tank of the Ministry of Finance. We are an institute that works with central and state governments, with their ministries of finance in particular. The perspective I want to bring to this panel and on finance and public finance is that there are different levels of government, and the way yesterday we discussed about capacities that are required at the lowest level of government. Similarly here as well, when it comes to financing disaster risk resilience, we need to keep in mind that there are different levels of government. In a country like ours particularly, where we have a federal structure, we need to keep that on the top of our minds, because who owns the risk, who bears the risk, who pays for it, who does the mitigation, where does the money from mitigation come from, and where does the money from for the response, recovery, and reconstruction comes from, has very much to do with what level of government you're at. Let me start with something that has been much discussed here already, so very, very briefly, that I think there is a clear understanding that most of infrastructure is publicly owned all over the world as well as in India. It's not even necessary that it should be publicly owned for the discussion that we have in mind, because very often governments need to step in both to encourage resilience, because they want the functionality of the public utilities for the population, so they step in to set standards, to regulate, and they may also step in later in terms of providing response and quick recovery, whether they own the infrastructure or not, but because it is essential for maintaining the economy going and for minimizing the loss to human lives and to livelihoods. Governments have a role to play, clearly. So given that, and of course given that all this needs money, let's just try to think through in public finance, what are the kinds of funds that are thought about and how we may approach this question of how to build resilience in infrastructure. The first is, of course, mitigation. Mitigation funds and financing mitigation may mean that there are higher upfront costs. There's been enough of a discussion on life cycle costs. So there may be higher upfront costs, but that might mean that there are lower life cycle costs. Further, whatever can be mitigated should be mitigated within reasonable conditions, of course, and to a reasonable level. And beyond that, unfortunately, there will be some risk left. Now, that residual risk can either be retained or it can be transferred. And the main theme of my presentation is going to be how we think about mitigation funding and retaining risk, and at each level of government, what should be done. Typical uses of mitigation funding that we see around the world, so in countries like Australia, Canada, Mexico, we see that mitigation funding goes into risk assessment that involves hazard, exposure, vulnerability assessments, risk atlases, and building early warning systems. There is, in addition to this, local capacity built for disaster protection, sometimes specific infrastructure to reduce disaster risk or to build resilience, such as levees and embankments or cyclone shelters get built. However, we find that when we look around, the amount of money that goes into mitigation, specifically under the budget head of mitigation. So I'm really not talking about the money that goes in when you're setting the standard, when you're doing the cost-benefit analysis for an infrastructure project. I'm talking about the budget head mitigation funding specifically. That is usually a small corpus. So that is not to say that money is not being spent on mitigation, that it's not to say that projects are not being made resilient, but it is simply to say that it is not that a separate budget head puts a lot of money into mitigation funding, usually. When we look at mitigation funding in India, this is currently a part, 25% of flexi funds are supposed to be part of all federal central schemes, and that's where money for mitigation can be used by state governments. There is no thorough review so far on how it has been used, but that's what the current arrangement is. There are certain budgetary allocations that are made for specific projects for reducing risk. So there's a national cyclone risk mitigation project, a dam rehabilitation and improvement project, for example, some of these funded by the World Bank. Those are specific projects which are for reducing risk. And then these projects also include early warning systems, include retrofitting. So that's the money for specifically under budget head of financing mitigation. Of course, it's something that we've just started doing. The National Disaster Management Act has other guidelines for mitigation funding that have yet to be implemented. The questions here, and these have been discussed much in the last yesterday and this morning, are we have to choose what is the optimal level of resilience. We have to think about how can mitigation be encouraged. So that's part of the role of the government. One approach could be to say that everyone has to buy insurance, and the insurance is compulsory, but does that lead to a moral hazard? In other words, knowing that insurance is compulsory, maybe people will not put in place measures to reduce risk. However, is it that if insurance premiums are risk reflective, that means that your premium goes up? If you haven't put in measures in place, then actually you do get encouraged to put in more resilience. Now, those are questions that are yet to find answers. I think I can confidently say that we don't know how this would work in India. Even in other countries, there is limited experience of how it has been working. As I said, we try to mitigate away whatever risks we can, reasonably do so, but beyond that, there is residual risk, and we have to think about how to handle residual risk. Now, it may be that an economy is very large, like ours, where there are different kinds of hazards, there are different states, different levels of government. We could take the risk of 1 to 2% hit of GDP, which our budgets can absorb. And that's pretty much the default mode, that risk gets retained at the level of the economy. But the severity of the disaster, the frequency of the disaster, as the size of the economy and the health of the economy will be the determinants of whether you choose to retain risk or not. You can think of instruments of risk retention as budgetary reserves. So money could be put aside into a reserve, or simply that if there is a disaster, there can be reallocation of resources. There could be additional taxation. The government could borrow, or it could choose to go for international aid. So those could be the kind of instruments if the government thinks that it is possible to retain that risk. Now, really, this decision at the level of the government is a decision of the Public Debt Management Agency. The Public or the Debt Management Office of a government decides. So whether we could be talking about a state government, or we could be talking about the central government, but it is its DMO or its Debt Management Office that decides whether it has the capacity, whether the budget, the treasury has the capacity to retain that risk, or whether it should try to transfer the risk. Now, in terms of, if it's a very, each economy is different. If it's a very small country, and it has very high severity disasters, which are of low frequency, such as a country that may have earthquakes, it may choose to transfer that risk internationally. The answer may be different for a state within a country and for a national government. So they can be different answers depending on what the overall risk profile of the country is and what your fiscal mechanisms are. But suppose you are a small country and you choose to transfer risk internationally. There are many instruments, insurance, by parametric insurance, catastrophe bonds, drawdown facilities, and so on. So it could choose one of the instruments available with large insurance companies, international insurance companies. It could choose instruments available with MDBs, who are able to provide some facilities to do transfer risk internationally. Within a country, the state government may transfer risk to the central government. So there may be a fiscal mechanism in place, which is pretty much what we are doing, where the central government then steps in to support the state government, and funds are made available for response. Now, again, the decision of whether the central government would then, in a federal structure, retain the risk or to transfer it after the states have transferred risks to the central government would be a decision of the Debt Management Office, because that will depend on the capacity of the overall central government budget or the national budget to absorb it or to transfer it. In India, states transfer most of the risk to the central government, which retains that risk. So we're not doing an international transfer of risks, and we yet have to think about whether states should be directly doing an international transfer of risk or finding market instruments, or whether we need to come up with a mechanism which ensures that state governments get immediate money as and when required. But that's something that needs to be worked on. Looking forward, India is going to be building a very large share of the new infrastructure that is going to be built in the world. So in the next 20 years or so, if you look at countries building new infrastructure, we are going to be having the biggest share of that infrastructure, of the new infrastructure that is to be built. So we are very much interested in these questions. So far, the approach has been that we can retain the risk that we have. It might be that looking forward, given the discussions we've had yesterday, given the climate change scenarios, given the implications of what this would be for increasing disaster risk for our infrastructure, this strategy needs to be rethought. I would want to draw a parallel in this field from the field that NIPFP or my institute has been working on. We've been working on financial sector legislative reforms, where one of the big problems that we try to solve and come across is that there is a lot of mis-selling in the sector, particularly in insurance. So in India, we find that to ensure consumer protection, the insurance regulator tries to say the financial advisor should be different from the distributor. So the person who's telling you that you need to buy these kind of financial products, that you need to buy insurance, that you need to sell catastrophe bonds, should be not gaining in any way from the consumer actually buying those products. In this space, one feels that it is not a consumer, an individual consumer who is often irrational and gets influenced by distributors who currently give that advice as well. It is governments, but it is not as if it's very easy for governments to take these decisions rationally or easily. Governments today have very little capacity to figure out the optimal level of risk, how much should be mitigated, how much should be retained, whether it should be retained, whether it should be transferred, or how we work on the fiscal mechanisms of the structures that we have in place. If we choose to transfer, what should be the instruments that should be used for transferring? The capacity is limited, not just at the level of the central government, but once one starts thinking of who owns that risk, if it is state governments, if it is local governments who have to put in money for mitigation, if it is local governments who have to come up with response funds.
Professor, sorry, please observe
It's my
time.
last slide. They will run up against capacity constraints. And in this scenario, it would be very useful to have advisors who don't have such a conflict of interest. But I think that's a question that needs to be discussed by all of us, because as discussed yesterday, the countries present here, bear a lot of the risk that's going to be arising from building new infrastructure. Thank you.
Thank you. Thank you very much. It is very comprehensive. I think one point that we need to focus and to put more thought is before, we always, when we look at the financing, we look at, the aftermath activities for the restoration for mitigation measures, which actually costs a very high cost of restoration and recovery. But nowadays we're entered to a new page of resilience, and we look at the resilience and prevention. So one thing that I would like to bring it up to the attention of this session is, let's think about this, and maybe that we need to do more analysis, comparative analysis by both the financing institution and also by the academia to look at, what exactly the implication, the financial costs of doing it upfront and to make it more resilient, disaster resilient, or we still go with most of the activities after the disaster and the natural calamities. Now, with this, I would like to invite Ms. French from DFID and the UK Center for Global Disaster Protection for her presentation.
Thank you, Chair. I'm afraid I don't have a presentation, but I'm just going to make 3 points. But also, I am not from the Center for Global Disaster Protection. I'm actually just the Deputy Head of DFID India here, the UK's Department for International Development. So I don't want to be missold in terms of who I am. So there were just 3 points I wanted to cover today. The first of all is just a reminder of the presentation that was made by one of our colleagues from the Cabinet Office in London yesterday about the approach that the UK is taking to disaster risk in its infrastructure development domestically. Look at one approach that we're doing, working globally to develop innovative financing mechanisms, and then just highlight some approaches that DFID is taking globally as well to work with partners to support disaster resilient infrastructure. So in terms of how the UK is approaching disaster risk reduction, one of the things that we are doing and investing in a lot is through disaster risk insurance. So this is a major focus. We're putting policy measures in place to mandate disaster risk insurance for both private institutions and public utilities. So this is an important area, and it's an area where we have significant expertise. The UK is one of the world's top financial centres. London is the largest global hub for specialty insurance, and we offer sophisticated analytics, innovation, and an unrivaled cluster of specialist insurance expertise. So we're drawing on that to shape the UK policy in terms of its development. But what we also wanted to do is also share some of that expertise globally. And in July last year, the UK government, through DFID, announced its intention to establish this Centre for Global Disaster Protection in London. And we're doing that with colleagues from the World Bank, with civil society, with private sector. So it's a combination of the best partners that are out there available, and providing some cutting-edge science, innovation, and neutral advice to support developing countries to build their financial resilience. And the UK Prime Minister inaugurated the centre, showing our commitment to support disaster resilience globally. So the centre will build the financial resilience of developing countries to natural disasters. It will do so by working with governments to strengthen pre-disaster planning and help them to use financial tools like insurance to access more rapid and reliable finance when the disaster strikes. So there are 4 sort of separate activities of the centre. So first of all, as I say, there's the providing the impartial advice. It's about training, it's about risk analysis and financial analytics, as we've heard from some of our colleagues about what's going on globally, and offering this support to developing countries to design and implement the risk financing arrangements. The second thing the centre will do will be invest in high quality data. It's about the science and the research that are needed to design these systems. One of the third things that we'll be doing is catalysing innovation. So with a focus on innovative financing tools for resilience. And one of the activities that's going to be taking place in the first part of this year is establishing an innovation lab. And one of the first sectors it will focus on is risk financing for infrastructure. So this will bring together experts, this lab will bring together the experts from the public and private sectors. And what we want to do is to generate and incubate new solutions to meet some of these problems that we've been discussing over the last couple of days. So we will pilot approaches, we will look at different ways of taking this forward. And as I say, this is taking place in London in the first part of this year. So success for the centre, it's not just about having the finances in place, but for the finances to be in place to deliver faster and more effective responses following disasters. So the centre will work alongside existing programmes that build systems and capabilities and to deliver that aid and that assistance to people quickly and efficiently and ensure that disaster risk reduction is adequately invested in. So just to say a few words then about what DFID is doing globally. So we're not just talking about this, we are actually putting our money where our mouth is on this issue. So the UK invests 30% of our total climate funds are devoted and dedicated to climate change adaptation. So that's the highest amongst the bilateral agencies. And resilient infrastructure is a key component of that. The second thing is here in India, disaster resilience is a key cross-cutting topic across our programme portfolio. And we are providing technical assistance to build climate resilient and productive infrastructure in one of India's flagship public works programmes, NREGA, ensuring that the energy infrastructure is resilient. And another area is supporting the smart cities to develop climate risks insurance instruments and invest in resilient infrastructure. So two very important issues here in India. Secondly, we're doing this in a regional context, so supporting 7 Asian cities to support better planning and design of urban infrastructure, and we're doing that working in partnership with the ADB. And then we've committed £12.5 million to capitalise a regional insurance scheme, the Pacific Catastrophe Risk Assessment and Insurance Initiative. So just to conclude on some of these issues, I mean, we have heard very clearly from my colleagues how important the disaster resilient infrastructure development needs an integrated and systemic approach. It requires strong leadership. This is a leadership role that we've taken in the UK, and putting those policies in place is essential for some of this prevention in the future. Climate-proofing infrastructure is also critical to build resilient infrastructure, but there is a limit due to some of the cost implications. So I'm welcome some of this discussion on the financing here. And I think one of the things that we have learned is just the value of insurance, but also we know here in countries like India and other countries, there is a huge market opportunity for this insurance. So we need to build on some of this momentum. And I think, just welcome the fact that this workshop is taking place at the right time, and that this discussions will lead to some identification of some solutions to drive that finance and drive that disaster resilient infrastructure development. Thank you.
Thank you. Thank you very much, Ms. French. Now we would like to invite Mr. Yellurkar, the head of the risk of IDFC infrastructure finance, for presentation.
I'm Dhananjay here, and today I'm going to talk about how private sector looks at funding this. I work for IDFC Infrastructure Finance, which is basically funding SPV projects in infrastructure in India, and they are mainly with the private sector only. So this gives you a flavor of how it is that private sector financing is happening to these PPP, non-PPP projects, and what we look at as some tools to look at EPC risk or construction risk or design risk or O&M risk, and how we take into account these while financing these projects. So basically, let me begin with a snapshot that, as you can see, this is a 15-year snapshot. India is, the investment trend is around 5.6% of the GDP, and 2.6% is by the private sector. So private sector has caught up from 0.08% to 2.6% over the last couple of years. And in fact, the investment in infrastructure had peaked at 8.37% in 2012. Post that, there has been a drop, mainly on many of the internal issues, but slowly it is coming back. And what I wanted to stress here is private sector investment is nearly as much as government investment in infrastructure. And when I mean infrastructure here, we are talking about power, transport, which includes roads, and power includes the renewable sector, which we focus on, and also it includes transmission, it includes hospitals, education, etc. I also wanted to stress a peculiarity of India, that bank credit to infrastructure is huge, and that's how mainly the infrastructure for private sector is funded. Though it is currently has fallen to 12.7% of the yellow bars indicate the bank credit to in total, and the line indicates the percentage for infrastructure. So around 12.7% of the bank credit goes solely to these big infrastructure sectors. This is a snapshot of the future which has been already covered, so I'll focus on the main tools that we have as a private sector financier. Here again, this is broadly classifying the fact that government looks at mainly budgetary support or multilateral to fund infrastructure, whereas private sector looks at financial institutions, banks, and capital markets. And capital markets is only available for operational projects in India which are rated at least AA+. So there is a whole category of projects which are still operational but are funded by banks because they do not meet the capital markets criteria. This gives a snapshot of the key financing players in India currently, and it includes the developers or the corporates, which are the large ones like IRB is basically large in the transport sector, Tata Power, Adani, Bharti in telecoms. And the key things here is now a lot of international funds are coming in as private equity players in the market. These are in the nature of BlackRock, the government of Singapore, Brookfield, etc. There are government institutions like REC, PFC, etc. There are private sector banks and NBFCs, where I am part of, including IDFC, L&T Infra, ICAC, etc. Plus there are public sector banks. So there's a whole gamut of players here. This is a typical deal diagram for private sector financing in India, which is the key point here I want to stress out is there are many stakeholders to financing a project. It's not just one entity, but there is the sponsors which bring in the equity, the government through the concessioning authorities giving the license agreement, there are insurance companies, and there are financial investors like us which are providing the debt. Then there are users, there are other agents like the trust and retention account holders, there are EPC contractors, there are O&M contractors, there are insurance companies. So it's a complex stakeholders, and we all rely only on cash flow financing from the infrastructure project. So whenever risk happens, what are the tools that are available, because these are ring-fenced cash flows that we are talking about. As an infrastructure financer, what kind of risk we look at and what are the key mitigates that are there available with us. So sponsor risk is one of the key risks that we look at, because if you look at how the concessioning authority bids out a project, there is a whole lot of criteria which goes into awarding a contract or awarding the BOT or PPP project. It also looks at who is the sponsor, what is his history, how many projects he has completed, whether he has got equity in the projects, whether financial closure has happened, etc., and whether there has been any defaults in the past. So one is the key category is the sponsor risk. There are regulatory risks, but I'll cover more from the other aspects. Market risk is another key, especially for toll roads or even in the power sector when we are talking about the PLF generated by a wind project or a solar project, etc. So how do we look at it at market risk? We basically rely on market studies prior to doing the investment or funding these projects, and these are through independent agencies. We look at the price paying capacity and what is, if it's a toll project, what are the traffic analysis there. In construction risk, basically, I think in the morning session it was touched upon that by the time the concession is awarded and by the time the project is ready for financial closure, it takes around 12 to 18 months. And that's the time, and government, the concessioning body doesn't take the design risk, especially for transport sector here I'm talking about. So the design risk is passed on to the developer. In that case, what happens? Because during the bidding stage, only a pre-feasibility study has been done, and kind of a basic analysis is done. But during the 18 months, the developer needs to do a complete feasibility study, the costing for the project, and he needs to get into the financiers to get back this project. So there are various things that we look at, because most of the time he has to enter into a fixed price EPC contracts. There are what kind of performance guarantees are there. Then we have, as lenders, we rely a lot on other experts in the field who will give comfort to the lenders that whatever project has been there, whatever has been cooking up, whether it has been exactly as per the standards laid down. So we rely a lot on lenders, engineers, and lenders insurance advisors for that. In the O&M risk, again, we rely a lot on what are the tools that we have built up in financing these infrastructure sectors. Basically, I will give you an example. For the road sector, when we look at these projects, there's a major maintenance reserve that is built up. And this is built up from the cash flows of the project, and the cash flow, that waterfall is there. Post building up the reserve, whatever cash is remaining goes to the developer. So over 5 years, a big kitty is developed to do a major maintenance which gets certified by the concessioning authority. So the key phases in the under construction and operational phases is, in the operational phase, most of these risks have fallen out and only the O&M risk remains. So most of the private sector players improve their credit rating at this stage, and they can access from the bank credit to the capital markets. These are some of the key scope of work that we look at when we get into the lender's engineer hiring. And they are the ones who do a key review of the project documents, whether they are EPC contracts or O&M contracts. They also do the design review and tell us as lenders whether everything is as per the design that is laid down. And most of the time the design is also vetted by the concessioning authority, though not always. Same case with the lenders, insurance advisors. Their key role is doing the risk assessment for the project and whatever lending or whatever policies have been taken to tell us whether it's appropriate or not. So these are the, during the construction and operational phases, what kind of insurance products that we use. Of course, there is a construction all risk which covers any damages during the construction. Of course, there is a delay in startup or loss of profits, but those are extreme. They are finally, it's a cost-benefit analysis taken out. In the operating phase, also mainly it's material damage and business interruption. Another key thing that we are looking at is, apart from government and developers, there are a new breed of sponsors. Like there are sovereign funds coming in, PE funds, pension funds, and they are taking the operating risk for the projects in India for large infrastructure projects. And also there are new entities like refinancing institutions like the infrastructure debt funds and the investment trusts, where these projects, once they're operational, are holding. So thank you. So I hope I've done it in time.
Thank you very much. Now I would like to, with these presentations, and also as I mentioned in the beginning, the colleagues from the Munich Re and Swiss Re, if you would like to spare a couple of minutes to share your experience and whatever the views. Yes, you may come up if you wish, or you can do that over there. Yeah, this has been mentioned from time to time during the past sessions of discussion, and there are strong interests in what exactly the insurance, the market insurance can actually play, the role and the views in the disaster resilient infrastructure. So would you please?
Yeah. So I'm from Swiss Re. And I just wanted to supplement this discussion with a couple of interesting projects that we're involved in. And again, going back to what Professor Bilal spoke yesterday about New Orleans and the kind of risks it faces, we are in discussions with the city of New Orleans on risk financing. And they specifically highlighted two issues. One is the timely availability of financing in the event of floods. And the second thing that they also mentioned is that during restoration, which you also mentioned, it takes a long time once the immediate emergency response is addressed to actually get rebuilding the infrastructure. And that is also because, being a public entity, you go through a regular public procurement process involving tendering, inviting bids, evaluation, and so on. So the current facility that we are trying to put in place is a three-way contract between Swiss Re, the city of New Orleans, and an infrastructure services provider, where the infrastructure company is already pre-selected at pre-agreed terms, and there's a parametric insurance policy which is being put in place, which immediately, as soon as the flood indicators are triggered, within weeks a payment is made directly to the infrastructure services company, so that you cut down on the lead time of 3 to 6 months in procurement. So the infrastructure rebuild can commence fairly quickly to put the city back in working condition. The second case I just wanted to bring to the attention is, Samantha had made reference to the fondant structure, which is a fairly comprehensive structure of risk retention, financing, and risk transfer. There the federal government provides up to 50% of reconstruction of infrastructure. Now for the balance 50%, states have come together to pool their risks and buy insurance directly from the international markets. So again, just putting this in the context of what Professor Patnaik had mentioned, whether in a federal structure, the state ought to be transferring risks to the center, or can it buy from the international markets? Now again, different countries will have different legal structures between the center and the state, and financing mechanisms and so on. But I think it is worth dwelling upon it to actually see if states can pool resources, again in the context of India, and buy insurance directly from the international markets. So again, in the context of India, where reconstruction of infrastructure is not allowed under the utilization of the disaster relief funds, I would strongly suggest that policymakers look at bringing in the provision of risk transfer into the rebuilding of infrastructure under the current national policy. And I guess we can replicate this in other countries as well. Thank you.
Thank you very much. Now I would like to introduce the co-chair of this session, Dr. Ijjasz-Vasquez. Dr. Ijjasz-Vasquez is the Senior Director of Global Practice, Social, Urban, Rural, and Resilience of the World Bank Group. So with this now, I would like to turn the session to Dr. Eddie.
Mr. Wu, thank you very much. Much appreciated. And thank you so much for your very able sharing of the presentations. Let me start with a few points that stuck in my mind from the presentations and then open for a little bit of conversations before we move to lunch. And this is completely biased from my perspective. So with that disclaimer, let me say that, look what Ms. Cook from the World Bank highlighted is that we tend to talk about insurance as the solution for all, but an important message is that there's a large variety of financial instruments that need to be part of a comprehensive disaster risk financing strategy for countries. Second, that is not only thinking about the financial instruments to deal with the risk, but also once you get the money, how is the money going to be used? That's a really critical part of an effective disaster risk financing structure. She talked also about the important, in order to motivate countries to understand and set up these risk financing strategies, is to understand what are the contingent liabilities that these governments really have vis-a-vis natural disasters. The contingent liabilities by many governments are just seen in terms of risk, regulatory risk or risk of non-compliance of PPP contracts. But the reality is that many of these countries will need to pay for a lot of these disasters in reconstruction. They pay year after year, and not understanding those contingent liabilities is an important whole, an important, hopefully, motivator to open up these disaster risk structures. Finally, and this is something that also that Professor Patnaik brought to the table, that we cannot think of insurance only as a financial mechanism for risk transfer, but well-designed insurance mechanisms are the ones who give signals to users and to governments to start building higher levels of resilience to be able to lower the insurance premiums. If you don't have that cycle and that feedback mechanism, then the insurance that is not become as effective in terms of building higher levels of resilience in infrastructure. Two interesting cases that she raised, and I think that that was also connected to our colleague of Swiss Re on Japan, the importance of pre-disaster contracts save you not only a lot of time in the post-disaster reconstruction, but also saves governments a lot of money to have that certainty that knowing that after the cyclone season or after the hurricane season, companies are going to be ready with the materials and the equipment to move fast on reconstruction because they have pre-bid contracts. Is something that we need to, an important risk mitigation measure that we need to look into. And then she described the Mexico Fund then, which is really, even though it's a complex mechanism, what is really interesting is that it begins to share in an explicit manner the responsibility between the federal, the state, the local and the governments, as well as the household level, to be able to say, look, there are different risks at different levels and there are different insurance at different levels, and that insurance needs to start giving the signal that everybody needs to focus on resilient infrastructure, all the way from the household level, on the household infrastructure, to the federal level in terms of the federal infrastructure. Dr. Benson highlighted something that we see day after day, the government challenges of buying insurance. A Ministry of Finance needs to decide between building physical assets or using some of those funds to buy insurance. And let me tell you, when parliaments discuss budgets, buying insurance is one of the most difficult things to go through parliaments, and that requires a lot of information, mindsets changing, and it goes not only for governments, but it goes all the way down to households. And she highlighted something that I think we need to look carefully at. Both the ADB, the World Bank, and many other agencies have begun to develop and use consistently risk assessment tools for every one of our projects and operations. And I think that now that we've had a little bit of experience in these institutions, we need to figure out how to work with planning agencies, both at the national, state, and local level, to start incorporating these assessment tools as part of the regular appraisal process that these agencies undertake. So I think that this is something that we need collectively to learn and think through. Very interesting to see how ADB now has taken this in such a high level of importance that is using something that is very rare, using grant resources for non-grant countries. There's a public good function to start moving into building resilient infrastructure and kicking off and starting this machine this change in mindset requires sometimes the use of incentives. And that's something that maybe also federal governments needs to do with the local governments to make sure that the local decision making in design and choice of infrastructure levels incorporates the issue of resilience. Professor Patnaik had a really important set of questions. One is really how much money to use to reduce and mitigate risks versus how much residual risk to absorb. And this becomes a really difficult political, technical question. Countries with low level of GDP have very different choices than countries with higher level of GDP per capita. And therefore, as countries develop, that balance and that equation changes. But countries are not necessarily making those choices in an informed manner. And actually, this is not something that can be done alone by technocrats, but it's also that is an open discussion with society as a whole. What is the level of risk that we are going to keep and how much money we're going to put into reducing the risks? And also the question of how much do you do in terms of investment at the sectoral level, but how much do you do with a specific program? So India has done great progress on cyclone risk mitigation, on disaster, where you want to have catch-up programs versus how do you mainstream into the health ministry, into the education ministry, into the transportation ministry. And again, she highlighted again that how disaster risk financing strategies are very different from small countries or small island countries to large federal governments, becomes an important question for this global dialogue that we're having here. Now, finally, knowledge and capacity was something that Professor Patnaik raised and that I want to highlight. This is not something that you say, let's buy insurance or let's do disaster risk financing. That requires a lot of technical know-how on the specifics of risk and hazards, and the capacity of local and national governments to understand that information and to be able to make informed decisions, and the relationship between the insurance sector and the governments to be able to find that balance in terms of instruments and the process. I want to highlight Ms. French's point of how much innovation is still needed in this area, and I think that the Center for Global Disaster Risk Protection is going to be an important instrument for all of us to learn together. And then I'll conclude with Mr. Yellurkar presentation, which was really interesting on how they look at the various risks into this process, but also how little still the issue of natural disasters come through in the assessment of the private sector in the evaluation of projects. Generally seen as, look, we can ensure this process, but I think that as more knowledge and capacity is built into the infrastructure sector, this issue of standards and how the government, what level of resilience the government expects out of privately financed and privately owned infrastructure projects versus how much is it imposed on the insurance side and how much actually contingent liabilities from the risk, natural disaster portion needs to be taken. And I'll close that with Samantha's example of Colombia, which one of the major road infrastructure program for the entire country now has a standard processes where the government has said, this is what we expect the private concessionaires to do in terms of risk management, not the prevention and the level of resilience that these roads need to have, but also what are the rules of the game for insurance that they need to take. So a very rich discussion, many interesting points out of this conversation. And let me open now for questions and answers to the panel. If you can introduce yourself and the organization that you are associated with, questions to the panel in general or to a specific panelist. I'll group them in groups 3 to 5 so that we can have a little bit of conversation. And we want to start wrapping up this in about 10 minutes so that we can go for lunch. Let me see hands, and then microphones are roaming around. I see one over here. Let me see if I see any other hands. So we can have right here a second microphone and a third over there. Please, introduction and question.
Good afternoon. Good afternoon. Myself, Ankur Gupta. I'm part of Munich Re. So more than a question, it's more of a comment. Basically, while the role of an insurer and reinsurer as part of risk financing or risk transfer tool is very well established, but what I feel is that as an insurer and reinsurer, we can play a much larger role in the entire disaster management. So right from setting up the, let's say, disaster resilient infrastructure codes, because as the colleague from Korea in the morning mentioned that they do disaster scene investigation, that is what we have been doing when we settle claims, right? So the knowledge repository that insurers and reinsurers have over a large period of time can come and help institutes or governments to set up codes which can help reduce losses through these disasters. And of course, the role of risk financing and timely financing of these rehabilitation programs is without doubt very critical. So as Ms. Cook mentioned in her note, that these agreements have to be predefined, but when Ms. Patnaik questioned whether insurance can be result into, let's say, moral hazard or people taking less care of their risk, I believe it is still a debatable factor, but these are not, it is not a significant enough factor to not promote insurance as a solution for risk management.
Absolutely. We look forward to a much larger role of insurance companies really trying to bring and building the knowledge and capacity of this process. We have a second question over here, and then a third question over there. Microphones coming your way. And then if I can have that microphone in the back to the third question over here. Go ahead.
Bilal Ayub, University of Maryland. My question is about liability that will cross borders. Let's say if a country has insurance and then there is a storm that will end up damaging a nuclear power plant like what happened in Japan, and there will be third-party liability claims from other countries. How would that be dealt with? I'm curious to hear from the panelists.
Any thoughts on that? And their third question over there. The microphone is coming your way. And let me see if there is any other hands for this third group. Okay, we see a hand over there, number 4. Yes.
Thank you
Quick
very much.
introduction.
My name is Kees van der Guchten from the Netherlands, Knowledge Institute Deltaris. I think there were interesting presentations on the financing schemes that are around, and from the different multilateral banks, they explained on how it works. However, it looks very much as business as usual approach. It is thinking, to my opinion, of yesterday, now trying to adapt it to the problems of tomorrow. Also yesterday and today we heard the challenges of the resilience as a new wording. It's also related to climate change in the future, uncertainty. Doesn't it need a new thinking in the banking sector itself? Could it, well, for example, words, as also the former questioner said, how to think about cross-sector financing, having investments on the one side and the profits on the other side. How to link it better with the climate change adaptation and funds that are around over there. How can the disaster risk reduction financing maybe collaborate more than it looks right now?
Wonderful.
Does it has new thinking?
Important question on how, if these infrastructure assets are built for 30, 40, 50 years of useful life, where we're going to see important change on climate and the frequency and strength of natural disasters, how does that come into the equation on the entire disaster risk financing? We have a fourth question over here. Raise your hand so your microphone can come your way, and if you can do quick introductions, and then we'll go with this set of questions to the panel. Please.
Hi, my name is Sita. I'm from the National Institute of Public Finance and Policy. I just was very interested to hear the perspective of the private sector, not in terms of insurance, but actually the source of funding, because as Professor Patnaik said, 3/4 of it is usually public, as in governmental. And it was very interesting to see a bank's perspective as well on top of that. Now, my question is really, so not IDFC obviously, but like a much smaller bank, if it fails and there is no regulatory process for its resolution, I mean, in a country where banks could fail, should they really be financing infrastructure in the first place? So for example, in the case of India, where the regulatory framework is still developing, the monetary policy framework is still developing. Inflation targeting has just taken off, and banks have day-to-day liquidity management to handle on top of that, which is somewhat not entirely predictable. Would short-term deposits and long-term infrastructure investments really align for smaller banks?
Wonderful. So a question on really, how do we start bringing resilience into the dimension of countries where they have nascent financial markets, where they have markets that are still struggling with the basics of financial regulations and financial capacity. In those situations, how to bring the concept of resilience in a way that is more rational, where you're just taking the first baby steps in the banking sector. So again, thoughts about disasters across countries, how to build, any thoughts on how to handle those questions, but also how to do pools of financing across countries to support and to enhance disaster risk financing. A question on how to start bringing the changes that climate will be bringing to the risk and hazards, to the whole issue of disaster risk financing solutions, and then finally how to bring the resilience in the case of countries with nascent banking and capital markets sector. So I'll open it up and see if any of the panelists wants to do it. Why don't we start with Mr. Yellurkar, and we come this way.
Yeah. First, I'll talk about why bank financing for infrastructure when banks could fail, etc. So please try to understand that these are very large projects, and it's not a single bank which is taking an exposure in the project. It's generally a consortium of banks, and each bank, there could be a consortium of 7 to 8 lenders in that. And there is one main lender which is the lead bank. So each one takes exposure as per their risk appetite for that. And also, it is not a single person's decision to give a loan, such a large loan. It goes to 3 levels of credit committees, and this is more of a collegiate decision where a lot of intelligence is sought from the external markets, whether it's through specialist studies. So even financing for one such a project could take at least 3 to 4 months of studies. Only then do we take such decisions. So it's not a decision which is taken without due care or due diligence. And again, like I would stress, it's more of a consortium funding. And regarding insurance for a power project which is in an operational phase, generally there are force majeure clauses which in the concessions which are embedded, if there is an act of God, or if it's a tsunami or whatever it is, if there is a disruption in the business for 6 months, generally the project has taken an insurance to cover the business interruption risk. So whatever revenue or profit loss is there, that is generally covered through the insurance.
Professor Patnaik, any thoughts?
So I just want to get into this discussion about financial institutions in India financing infrastructure. What we've heard so far is mainly about how it gets financed, but very little about how disaster risk resilience is brought into this picture. Are banks or other financing institutions able to start thinking and looking? I mean, what one knows so far is that this is not something that banks typically in India look at. They look at the schedule. If things are going fine according to the schedule, then pretty much release the next tranche of loans. But have considerations of disaster resilience started coming into the construction? So when the design is approved, or so it's about mitigation and not really the insurance in case of a hazard, but about mitigation.
A little bit on that part. Like I told you, by the time the concession is awarded and the financial closure happens, that's where all these studies are done. And most of the time, let's take a case for a road project in India. Unfortunately, the concessioning authority and the regulatory body for that is the same entity. So there is a very little differentiation between that. But having said that, most of the time, the design risk is not taken by the concessioning authority. It is passed on to the developer. So what does the developer do? And the project cost estimate is generally gets inflated or increased because of there are many nuances within the 18 months which the developer, I'm not talking on behalf of the developer, but this is what exactly happens, that the soil testing, or that there are loose mountain soil which is coming down. So all these aspects are taken by the developer during a detailed feasibility study. And I know disaster risk, suppose we are funding a small hydro project in the Himalayas. So all these factors are taken into account as to what kind of damages could happen, what is the history, what kind of infrastructure needs to be built, and finally it's a cost-benefit analysis. We can build the best or whatever, but finally it's a risk-return relationship also kicks in. But having said that, the government also has their own specialist engineers which vet these studies before they come for financing.
Much to be done in that area. I think that this is an area of topic of between the private concessionaire, the regulator, the financiers, and the insurance. Much to be done to bring the whole dimension of resilience into this process. Samantha, thoughts on the questions?
Okay, on the first one, on the third-party liability, generally I've specialized in the exact opposite, actually. Which is quite interesting that you asked that question, because what we've been very careful in doing when we establish risk pools is trying as much as is possible to ensure that there's no cross-subsidization of risk. So having an insurance contract that crosses borders, that would not be impossible. The insurance sector, highly innovative, always is, but it would be very dependent on your underwriting. It would also be dependent upon some sort of shared premium, some form of shared capital, and so it would actually have to have quite a complicated structure. I think it would take quite some time to come into fruition, but it's a very interesting point that you flag. And also with this cross-subsidization issue that I mentioned, the way in which we did that, and this relates to the question that was asked about incorporating climate risk, when we did the risk assessments for countries in order to enable them to purchase parametric insurance against tropical cyclones, earthquakes, and so on, we do try and factor those in. Now, one thing I do want to highlight with that in particular is because the climate change science is constantly changing, people's exposure is also constantly changing via investment in infrastructure. It's also important that these models and their inputs are also constantly revised. So yes, we are trying as much as is possible to incorporate climate risk into it, but equally I think there's more that can be done. The better we get with our scientific analysis, the better the financial products can become on the back of it. And then the last point that I wanted to make with regards to the bank failures, I think that's actually a really important point. And this is one of the things that the London Centre, sorry, I refer to it as the London Centre. We've been quite involved in establishing it. Now, there is going to be a small component of that which actually looks at the regulatory sector to try and make sure that what's happened at the moment is there's a gap between developing countries and developed countries with the insurance regulatory sectors there. So the IAIS has standards set to here. Developing countries generally are able to implement to about here. So one of the key tasks of the London Centre is to try and fill this gap. And one of the things they're doing is having a lot of conversations with IAIS as to whether there should be some sort of reduction in the barriers of entry to the insurance markets within developing countries so that they can grow their regulatory capacity alongside the size of the regulatory industries and making sure that, again, they've got the right amount of capital to support these complex financial tools.
Absolutely. Dr. Benson?
Thank you. I'd like to address the comment from Case about business as usual. I would argue it's definitely not business as usual. There has been a significant shift, not least in ADB. The disaster risk management team and the climate change team are now under one division within a bigger department, so we work very closely with our colleagues on climate change. We have joint risk screening tools. We have joint work plans and so on. We heard yesterday from my ADB colleague about some specific examples of ADB work on flood risk management where we're moving away from a strictly structural approach to building non-structural solutions, to building nature-based solutions, to take basin-wide approaches. And that in turn has been partly triggered by concerns of climate change, that one cannot proceed as per normal, return periods and so on are changing. So embedding very much climate change into work we do on disaster risk management. In terms of disaster response as well, we've shifted from basically an ex-post approach where we wait for something to happen and then we process support to a situation where we now recognize, I think we always did recognize, but we're now providing instruments that recognize that the faster one provides the recovery reconstruction support, then the less of the social and economic consequences of direct physical losses, and we're putting in instruments specifically to address that. And of course, embracing Building Back Better. 10 years ago, before the Aceh tsunami, we didn't really talk about Building Back Better. That in itself is a shift, and that incorporates climate change adaptation as well as disaster resilience concerns. Thanks.
Thank you so much. So now please join me in thanking, of course, my co-chair, Mr. Wu, but all of the panelists for a really fascinating conversation on DRF. I will get instructions on the lunch. Many thanks.
Thank you, sir. Now we break for the lunch, and I request everyone to kindly reassemble at exactly at 2:30.